If you are not investing your money in 2025, you're falling behind. While your savings sit in a bank losing value, the wealthy are getting richer just by doing this one thing. The good news? You don't need thousands of dollars to start. You can start with $100 in your pocket today. In the next few minutes, I'll walk you through exactly how to start investing, even if you've never done it before. Here's the truth. If you're not investing, you're actually losing money. Why? Because of inflation. That $1,000 in your savings account buys less every year. Meanwhile, the stock market averages 8 to 10% returns over the long term. That means while your money sits, other people's money is growing. Let me give you a simple example. If you invest just $100 a month starting at 25 at a 10% return, you'll have over $300,000 by the time you're 60. But if you wait 10 years and start at 35, you'll end up with less than half that, even if you invest the same amount every month. That's the power of compounding. Every day you wait to invest is the day your money does nothing. It just sits there losing value. Investing isn't about starting rich. It's about protecting and growing your money. Investing is about buying back your freedom. You don't need to time the market. You don't need to pick the next Tesla or Nvidia. You just need to start. Consistency beats perfection every time. And now it takes less than 5 minutes to download an app and start, so there's no excuse not to. So now you're thinking, okay, I get why investing matters, but what do I actually invest in? Let's break it down fast. You've got options, but let's keep it simple. First, stocks. When you buy a stock, you're buying a small slice of a company. Apple, Tesla, Google. If the company grows, so does your investment. But picking stocks can be risky. That's where ETFs come in. They're like a bundle of stocks in one. Instead of betting on one company, you're investing in hundreds all at once. VTI tracks the entire US stock market. One click, instant diversification. Then there's index funds, very similar to ETFs. Just think of them as slow and steady wins. Want global exposure? There's ETFs for that. Want just tech companies? There's ETFs for that too. You can also invest in bonds, lower risk, lower upside, or REITs, which are like buying real estate without the headache of tenants or toilets. There's crypto, but it's high risk and super volatile. Probably not where you want to start. The point is, you don't need to be a stock picking genius. You just need to pick a smart, diversified option and stay consistent. And yes, you can do this all from your phone. Knowing what to invest in is useless if you don't know where to put your money. This is where beginners get it wrong, because if you choose the wrong account, it could cost you thousands in taxes. Here's a quick breakdown if you're in Canada or America. In the US, think Roth IRA and 401k. Roth IRA, post-tax money in, tax-free growth out. 401k, pre-tax money in, taxed later. In Canada, you've got two main ones, TFSA and RRSP. TFSA, you invest, it grows, and when you take it out, no taxes. RRSP, you get a tax break now, but you pay tax later when you withdraw. These accounts let you legally avoid taxes while your money grows. If you skip this step, you're leaving free money on the table. Now, where do you actually open these accounts? For Canadians, Wealthsimple, Questrade. For Americans, Fidelity, Robinhood, Charles Schwab. These apps are simple, beginner friendly, and you can start to invest in under 10 minutes. Set up your account, verify your ID, link your bank account, and boom, you're in. You've got your account set up, money ready. Now the big question, what do I actually buy with my first $100? Here's the answer. Let's keep this simple. Don't buy random stocks. Don't try to pick the next Tesla or time the market. That's why most beginners lose money. If you're in Canada, one of the best is VFV. It tracks the S&P 500. That's 500 of the biggest US companies in one click. Apple, Microsoft, Amazon, all in. If you're in the US, there's VTI, which tracks the total US market, or VOO, which tracks the S&P 500. Both are top tier, low fee, and built to grow over time. If you want global exposure, go with VEQT. It includes stocks from around the world. You can set it and forget it. And these ETFs cost under $500 a share, and most apps let you buy fractional shares. So yes, even with just $100, you can start building real wealth. Bonus tip, reinvest your dividends. Most platforms do this automatically. It's called a drip. You don't need 10 different stocks. Just one good ETF can outperform your friends who are making 100 trades a day. Simple, boring, consistent. That's what makes money. Now that you're in the game, you've got your account, you've made your first investment, now don't screw it up, because most beginners lose money from what they do next, trying to time the market. Everybody thinks they'll buy low and sell high, but here's the truth. Nobody can time the market, not even professionals. You wait for a crash, you miss the rally. You panic during a dip, you sell low. Some of the biggest gains happen during random, unexpected days. If you're not in the market on those days, you lose out big time. If you miss the best 10 days in a decade, your returns get cut in half. The people who build wealth don't wait. They invest regularly, no matter what the market's doing. That's how you win long term. Checking your portfolio every day. Imagine planting a tree, then digging it up every day to check the roots. That's what checking your portfolio constantly is like. Stocks move every single day. Red, green, it's noise. And staring at that noise leads to stress, panic, and bad decisions. The market is volatile in the short term, but predictable in the long term. Instead of watching it obsessively, set a reminder to check it once a month, or better yet, once a quarter. Watching it daily doesn't help it grow. It just makes you anxious. Selling during a dip. The market drops, your portfolio is bleeding, and the panic hits. Should I sell before it gets worse? That's how beginners lock in permanent losses. Every dip feels like the end, but zoom out. The market always recovers. Always. If you had invested during the last crash and held, you'd be sitting on massive gains today. Selling during a dip is like jumping out of a plane mid-flight because of turbulence. It's uncomfortable, but the worst thing you can do is jump. Stay in your seat. Let time do its job. The investors who ride it out are the ones who win in the end. Chasing hype. If everyone online is talking about some hot hot stock or next big crypto, guess what? You're already too late. By the time it's viral, the smart money is already pulling out. Meme stocks, altcoins, the flavor of the month picks, they're like fireworks. Loud, fast, and then gone. Investing isn't about hype. Boring ETFs beat flashy trades over time. This is the silent killer. Quitting too soon. You invest for 6 months, don't see big results and think, this doesn't work. But investing isn't a lottery. It's a long game. The first few years feel slow, and then compounding kicks in. That's when your money starts making more money by itself. But if you quit before that happens, you miss the magic. Think in decades, not days. The people who stick with it, they're not lucky, they're just patient. The last and most common beginner mistake, going all in on one stock. You find a company you love, maybe it's Tesla, maybe it's Shopify, and you dump all of your money into it. But here's the truth, anything can happen to a single company. CEOs get fired, earnings flop, the market shifts, and suddenly your entire portfolio tanks overnight. Smart investors don't bet on one horse, they build a team. That's what diversification is. Instead of one stock, spread your money across hundreds using ETFs or multiple stocks. One bad stock won't kill your portfolio, and the winners carry the weight. It's not about hitting a home run on one stock. It's about staying in the game and building a team. Now you know what not to do. But here's the problem most people still have. They say, I want to invest more, but I just can't afford to. The truth, you probably can. You're just spending your investment money without realizing it. Let me show you how to fix that. Step 1, kill your credit card debt. If you're paying 19% interest, it's like trying to swim with a backpack full of bricks. Paying off that debt is the fastest guaranteed return you'll ever get. Don't invest more until that's handled. Step 2, trim the fat. You're not broke. You're just subscribed to stuff you don't use. Go through your bank statement right now. Spotify, Netflix, Disney Plus, random app charges. If you wouldn't miss it tomorrow, cancel it today. Step 3, money leaks. Check your last 30 days of spending. You'll find money that you didn't even know was gone. Eating out, daily coffees, impulse Amazon buys, it all adds up. Even $50 a month redirected into investing is $600 a year. With compounding, that's thousands down the line. The last step, automate it. The second you get $25 or $50, set up an auto transfer to your investing account. Don't let it sit in your bank. If you don't move it, you'll spend it. You don't need a raise or a new job. You just need a reset. All right, let's lock it in. If you're not investing, your money's falling behind. Inflation is draining your savings while you sleep. But with just $100, you can start taking control. You don't need to be a stock expert, and you don't need to be rich. You just need to start and keep going. What can you invest in? Stocks, ETFs, index funds, but the smart move for beginners is ETFs like VFE, VTI, or VEQT. One click, hundreds of companies, simple, effective, proven. Where do you invest? Inside the right account. In Canada, that's a TFSA or RRSP. The US, that's a Roth IRA or 401k, tax-free or tax-deferred. Either way, your money grows faster. Use beginner-friendly apps like Wealthsimple, Questrade, Fidelity, whatever fits you. Set it up once and you're in. But getting started isn't enough. You have to avoid the traps that most beginners make. Stop trying to time the market and stop checking your portfolio every day. Don't sell in a panic. Don't follow the hype. Don't quit when it feels slow, and never put everything into one stock. The people who win at this don't invest perfectly. They invest consistently. Now maybe you're thinking, I want to invest more, but I just can't afford it. The truth, you probably can. Go through your last month of spending. I guarantee you'll find money leaks, app subscriptions, impulse buys, and more. Stopping a few of these can add up to hundreds or even thousands of dollars down the line. Free up that money and move it to an investing account. If you don't invest it, you'll spend it. Thanks for supporting my brand new channel. I make these videos completely solo, and it means the world. If this helped you, hit subscribe. See you in the next one.